Hello, my name is Caleb Preston, and today we'll be answering the question, what is trust deed investing? In addition to this, over the course of this video series, we'll discover a closely held real estate investment strategy that investors have been using for decades to generate stable income. So, let's jump in. All right, there's three ways you can buy real estate. The first way is to use cash. That's when the buyer uses his or her cash to buy a property outright. The second way is to use the bank's money. That's to go get a loan at Wells Fargo, B of A, or from some other conventional or private lender. That's by far the most common way that real estate's bought and sold. Now the third method, which is the least known about, is to use the seller's money. And this is called owner financing or seller financing. And approximately about 10% of all real estate across the US is sold in this manner. Now, our investment opportunity is established in this process of seller financing. So we're going to take a closer look at exactly what is seller financing, how does this process work. Meet Tom. Tom is recently engaged and wants to buy a new home that's for sale for $200,000. He's self-employed and makes his income commercial fishing in Alaska every summer for wild salmon. He's had several good seasons and currently has about $70,000 cash in the bank. But Tom's got a problem. He went to the bank and got turned down for the loan. And the reason is that because he's self-employed. He makes almost all of his income in 4 months out of the summer. So it looks like Tom's out of luck. Meet Julie, who owns the property that Tom wants to buy. She's now recently retired and wants to move down to Arizona to be closer to her grandkids and her daughter. She's able to live off her pension but wants a little extra income to travel and spend on the grandkids. So, Julie wants income and Tom wants to buy her property. What's the solution? Seller financing. The two of them meet and Julie agrees to finance Tom, and she sells him the property for $200,000. In exchange, Tom gives Julie $50,000 as a cash down payment, and there's a new promissory note written for the difference of $150,000. Now this note is the exact same contract that Tom would have signed had he got a loan from the bank. The only difference is that this time, Julie is the bank. Now, since there's no bank involved, Tom and Julie are free to negotiate the terms of the loan as they see fit, as they want them. Julie is taking some risk being the lender, so naturally she charges a higher interest rate than the banks normally would. They agree to an interest rate of 7% and a term of 15 years. So what that means is Tom is required to pay $1,350 a month, and the loan's going to pay off over a 15-year period at that monthly amount. Now this whole transaction is closed like a normal closing through their local title company. Now in addition to the note, Tom also signs a deed of trust, which gives Julie the right to foreclose and take back the property if Tom stops making his payments. In some states, this document is known as a mortgage. So they're both happy. Julie's now receiving $1,350 a month, and Tom was able to buy this home and start his new family. All right, let's go ahead and fast forward now 3 years later. So Julie's been enjoying Arizona and has her eye on a property she'd like to purchase. She doesn't want a big mortgage payment, and ideally would like a lump sum of cash to apply to the purchase to keep her payments down. Meanwhile, Tom and his wife are enjoying their new home, and the market's actually gone up a little bit. The property's now worth $220,000, and at the same time, the note with Julie has paid down to $131,000. That's due to the 3 years worth of payments that he's made. Now I want to take a quick second here and highlight a very key ratio called loan to value, or LTV. Now LTV is calculated by dividing the balance of the loan against the value of the property. So in this case, Tom's loan currently has a loan to value of 60% since the note is $131,000 and the property is worth $220,000. So that means that Tom has approximately $90,000 of equity in the home. If he were to walk away from the loan right now, Julie could foreclose and take back the property to get back her investment. I think most of us would agree that Tom would be pretty crazy to default, and this is a pretty safe way for Julie to earn her 7% return. Another nice thing for Julie is that that return isn't based on what the stock market's doing or how interest rates are rising or falling. It's a steady income stream, based on Tom's ability to make his payments, and it's backed by the tangible value of that home. Also, unlike real estate rentals, Julie doesn't have to worry about keeping up on the property. That's Tom's job since he owns it. All right, now let's go ahead and get back to our story. There's hundreds of companies nationwide that act as brokers of these privately held real estate notes. McKinley Mortgage is one of these brokers, which my family started back in '89. So Julie receives a postcard from McKinley offering to buy her note for cash. She's curious, so she gives McKinley a call to see how much her note is worth. Now McKinley is able to offer her cash because McKinley has a network of experienced real estate investors that are willing to buy these notes for cash at a discount. Alaska Financial Company is one of these investors. On this specific note, Alaska Financial, or AFC, is willing to buy this note for $112,000 cash. McKinley turns around and offers Julie $107,000 cash, or 82 cents on the dollar. After giving it some thought, Julie agrees to sell her note since cash now is worth more to her than cash over the next 12 years. As a quick side, the top 5 reasons that people like Julie agree to sell their notes are: number 1, there's some kind of intrinsic value. Like in this case, Julie is buying a property so she can be closer to her family. That cash can help them represent. The second thing is that oftentimes investors will sell properties and carry back the note, and they'll sell that note for cash so they can then go out and do other investment deals where they can earn a higher return than what they would have earned by holding the note and receiving that interest. So you can get a better return elsewhere. The third reason is that many beneficiaries like Julie end up realizing that they aren't cut out to be a lender. Owning a note can take a lot of time, hassle, and work, and it's not for everybody. The fourth is that they have some very specific need for cash, either to buy a car or pay bills or may renovate their home. And the fifth reason is that the note is in an estate and needs to be liquidated to cash out the heirs. All right, getting back to our story, McKinley makes a commission by brokering this note to AFC, and AFC earns a 10% return on its investment. Now, you may be wondering, how does AFC make 10%? Well, for those of you that own bonds, you're likely familiar with the inverse relationship between the price and the yield of an investment. If AFC had bought that note for $131,000, the fund would earn 7%. But it didn't. It bought the note for $112,000, or a lower price, which enables it to earn a higher return of 10%. And also, if Tom stops making his payments, AFC is now the one that has the security or the right to be able to foreclose and take that property back to make good on the investment. In closing, let's review the advantages of having trust deeds in your portfolio as an alternative income investment. The first advantage of trust deeds is that they're backed by tangible real estate equity. There's either a home or a commercial building or some kind of property with abundant protective equity above and beyond the value of that note, protecting your investment. The second main advantage is that trust deeds often can generate above market returns, usually between 6 to 12%, depending on the type of note and the form of investing. The third advantage is that trust deeds can lower risk in your portfolio because they're non-correlated to traditional stocks and bonds, which means the factors that drive the protection and the return of traditional investments are not going to be the same factors that drive the return and security of your note. And the fourth advantage is that trust deed investing is a proven investment strategy. In our current open fund, AFC3 alone, our investors have received a 7% plus fixed return with no losses since January of 2009. Well, that sums it up. Thank you very much for joining us today, and stay tuned for our next video in which we'll discuss the distinctions between pooled and single trust deed investing. Have a great day.